Hello, everybody. Very warm welcome to this webinar. I'm very pleased to have this moment together with you, and I will present this benchmark, the outcome of this benchmark study with together with Florence Michel.
Hi.
So we will be all together for about 1 hour, maybe a little bit less. We will perform this presentation first, and all along the presentation you can send questions. We do our best to manage most of them. We will see how it fits with the presentation. But if you have questions, don't hesitate, and if we miss times to answer it in live during the presentation, we may revert to you back afterwards. So this presentation is about the financial performance of European banks in the context of COVID-19, and it seems quite logical, but we will dedicate most of the presentation to the ECL topic. Moving to the next slide, just as an introduction, we will present our sample and methodology. So our sample is composed of 26 European banks. You see the list there. There are from 11 countries, 4 French, 4 Spanish, 5 English banks for the main represented countries, but there are other, as you can see there. We have performed this study only based on information available in the annual report, the audited information published before the 1st of April 2021. So if additional information have been provided by the banks in other kind of communication or after the 1st of April 2021, it has not been taken into account for this presentation. We choose to favor a quite large sample of 26 banks, and we, as a consequence, we will focus more on global trends or things that we can identify on a geographical area rather than trying to explain the numbers or the figures of one given bank. So it would be really a benchmark across our sample. For this presentation, we have used the published indicators of the banks each time that it was possible, but in practice, it was rarely the case because we were looking for comparability as much as possible. So we had to make some estimates, some adjustments, some calculations, and each time that we use our own calculated indicators, you will see this magnifying glass that you see on the left of the slide. This will explicit the fact that the figure we present to you are one we calculated or one we had to adjust. As a consequence, each time that you will have this feature in the presentation, you will have a dedicated explanation of the methodology on how we computed the numbers. As we are using numbers that were calculated and not directly from the publication of the banks, we decided for the study to use code, and each bank will be referenced through an anonymous designation. So for example, you have 5 UK banks, so you will have UK1, UK2, UK3, and so on and so forth. So it's quite easy to identify the country, but not necessarily the bank, and that was our intention. For countries with only one single bank, we use the code other, so you will have banks O1 and O2. Just a last word before starting the presentation itself. We will use 2 concepts that have to be defined. When we will talk about expected credit losses, ECL. When we talk about ECL as an impact in P&L, we will talk about ECL charge. And when we talk about ECL as a balance sheet item on the asset side, we will talk about the ECL allowance. So please pay attention to this distinction, because sometimes we'll talk about ECL allowance and you have to think about the balance sheet, and sometimes we'll talk about the ECL charge that some name as well cost of risk, and then you have to focus, we are talking about the P&L impact. With these preliminary words, that's the end of the introduction, and I leave the floor to Florence, who will present the first slide.
So thank you, Vincent. This first slide is aiming to presenting the general context of this benchmark, and so it will present the changes in percentage of the operating profit or loss before ECL charge between year-end 2020 and year-end 2019. The definition we have adopted for this operating profit or loss is mentioned in the slide with the magnifying glass, and it consists in taking the gross profit or loss resulting from the business of the entity, but without taking into account the ECL charge, as said in the title of that slide, and also without taking into account the share in profit or loss of the associated entities or the asset disposals. To be more specific, this operating profit or loss will include the amortization of the assets and the impairment of goodwill. As showed by this graph, most of the banks experienced a decrease in their operating profit or loss before ECL charge, which is not a surprise. Just note that 4 banks are not in this graph because they experienced a loss at year-end 2020 or year-end 2019, and therefore the changing was not relevant to show. If we move to the next slide, we will present the share of ECL charge in the operating profit or loss before ECL charge. In fact, this is the weight in percentage when you take the ECL charge that you divided by the operating profit or loss, just defined in the previous slide. The data at year-end 2020 is the blue box, and the ratio at year-end 2019 is the gray blocks. Please note that a ratio over 100% means that the bank realized an operating loss at year-end 2020, for instance. If we look at the figures, we will see that the average at year-end 2019 was 21%, and it increased to 78% in an average at year-end 2020, which is quite a significant increase. At year-end 2020, the share of ECL in operating profit or loss ranges from 9% to more than 200%, which is quite a wide range. So,
now we will have a look at the increase in the ECL charge. So we compare the impact in the P&L of the ECL between 2019 and 2020. You have two items in the graph. The blue bar represents the difference between the full year 2019 versus 2020. And the small point represents the comparison between the first half year of 2019 against the H1 2020. So if you, and here it is a ratio actually. So if we take the example of the first column, if the bank FR1, it has a ratio of 2, meaning that the ECL charge in 2020 represent 2 times what was the ECL charge in 2019. So we see here 2 types of information. The first one is when you look at the blue bar, you have quite an impact that is quite homogeneous across geographies. For example, the French banks are all between 2 and 3. If you look at, for example, the UK banks, they are all around 3, and the last one was a little bit ahead of that at 5. So there is quite a good consistencies geography by geography. However, the main difference is the rhythm. That is to say, if you look at the position of the point compared to the level of the column of the blue bar, you see that for example, the French banks mainly have the same ratio on H1 on the full year. That is to say, they had quite an equivalent effort in terms of ECL charge increase over the year. On the opposite, if we look at the Swedish bank or the UK bank, you see that the point is really well higher than the bar, meaning that most of the effort have been made on the first half year compared to the full year ECL charge. So most of the increase of ECL was already performed on the 13th of June. If we look at the data, you see that the average multiplier effect was around 6 for the first semester and 3.5 over the full year. So on the average, most of the effort was on the first semester, but there has been a significant increase because, as you see, as an average on a full year basis, the ECL charge has been increased by more than 3 times compared to 2019. We see as well that we have some let's call it outliers that obviously drives a little bit the average that is presented here. Moving to the next slide, we will now stop to focus on the P&L and have a look on how behaved the ECL allowance. That is to say, we will look at the balance sheet level. Here you have the same approach. In blue, you have the increase in percentage on a full year basis, and you have the small dots in gray that represent the increase in percentage with the same approach, but only on H1. So we compare H1 2020 with H1 2019, and in blue you have the ECL allowance at the end of year 2019 compared to the 2019 31 December level of ECL allowance. So of course, it's not a surprise that we see all the ECL allowance increasing, and you see here that we have the same kind of effect. If the spot is in the middle of the bar, that is to say that the level, the increase, half of the increase of the yearly increase has been performed on the first semester. So once again, if you look at the French banks and for example Spanish bank 2 and 3 just in the middle, you see that the spot is quite in the middle. So you have half of the increase of the ECL allowance on the balance sheet that was on H1, and the second half was on H2. Then if you look at for example, the UK banks, the Irish banks, you see that the point is really high on the bar, meaning that most of the effort in terms of additional ECL allowance were performed during the first semester of 2020. If we look at the average level, you see that the average level on a full year basis is an increase by 57%. So it has almost not doubled, but it's almost 50% in addition to the level at the end of 2019. So it's a very significant increase of the ECL allowance over the year. The range of such increase is quite heterogeneous, because if you see the lowest level for an Italian bank, for example, is 11%, whereas for UK banks it's 120%. Of course, the situation of each banks have to be taken into account. One can imagine, for example, that the Italian banks they recognize a part of NPL portfolio, for example, that may compensate the increase of ECL overall. But nevertheless, as an average, you see that you have quite a significant number of banks that are around 25–30%, and then you have banks that are more in the range of more than 80%. So the increase of ECL allowance is really an element of divergence amongst the banks, but it should not be taken on its own. We will have in the next slide a look at the starting point of each bank that may explain why there is so significant differences between the banks. Florence? You are on mute, Florence.
So thank you, sorry. So we will now look at the global ECL coverage ratio. This is a common indicator in which the ECL allowance is divided by the gross credit exposures for all financial instruments in the scope of IFRS 9 impairment. It means that it will take into account the assets at amortized cost, at fair value through OCI, other comprehensive income, and off-balance sheets such as loan commitments and guarantees. We acknowledge that this indicator has a very aggregated level, but it should be seen as an indicator of the trend. This global coverage ratio has been calculated at year-end 2020 with the blue blocks on these graphics, and at year-end 2019 with the gray blocks, so that you can compare the evolution between 2019 and 2020. If we go to the figures, what we can observe on this graph is that the coverage ratio has an average increase of 12% from 1.03 to 1.15%, with a pretty good geographical consistency. If you look at this geographical consistency, you can see that UK banks have made a significant effort, underlined in the previous slides, but still fall short of French banks that are quite stable at year-end 2020 compared to year-end 2019. Concerning the Italian banks, they decreased their coverage ratio, maybe linked to their NPL deleverage plan, but they remained above the average. Please note that these changes are very linked to the composition of the underlying portfolios. Now, if we move to the next slide, we will try to understand this changing between 2020 and 2019 of the coverage ratio. So this slide will present you the changes of the gross credit exposures between year-end 2020 and year-end 2019. They are represented by the gray blocks. And the same for ECL allowance, so the ECL in the balance sheet, which are represented by the blue blocks. The entities have been ranged by increase of the gross credit exposures in gray in order to point out the lag with the increase of the ECL allowances. For almost all the sample, the gross credit exposure has increased with an average increase of 7%. Whereas the average increase of the ECL allowance is 28%. This lag between the change in the gross credit exposures and the ECL allowance is particularly true for the UK, Dutch, and Irish banks, if you look for the geographic consistency. And for these three banks, UK, Dutch, and Irish banks, we can note that the variation of ECL is significantly higher than variation of gross credit exposures. Now, we will focus on the ECL coverage ratio for amortized cost assets. Because, as we said before, the global coverage ratio is a very aggregated indicator in which the assets at fair value through OCI or off balance sheet have significantly lower coverage ratio from the assets at amortized cost. Therefore, in this graph, we have wanted to focus on the assets at amortized cost as a better proxy of loan and receivables. Besides loans and receivables, assets at amortized cost could include also debt securities, quite a few, most often, deposit with central banks, and other assets. If we look at the graph, the changing in the ECL allowance is the blue blocks. Is the blue box, and the changes the blue blocks will present the changes, the coverage ratio at year-end 2020, and the gray dots are the coverage ratios at year-end 2019. If we look at the figures, on average, we can see an increase of almost 10% from 1.42% in 2019 to 1.56% in 2020, with a great diversity in the coverage ratio from, for instance, at year-end 2020 between 0.4 to 3.2%. Again, UK banks made a real effort, but stay under the average, whereas the French banks are above the average.
Thank you, Florence. I hope everybody is finding this presentation, as you seems to be very concentrated, and don't forget, if you have any question, because that's a lot of numbers and figures, don't forget you can ask any question you may have on the chat box, which is on the right of your screen. You can ask a question and we will have a look at it by the end of the presentation if we have the time, or afterwards otherwise. So up to now, it was really figures at an aggregated level, and we will now try to go a little bit more into the details. And you have here a first split, which is a split by staging. So the graph at the top of the slide is the stage 1 coverage ratio. Then you have the stage 2 coverage ratio and the stage 3 coverage ratio. In each of these graphs, you have in blue the coverage ratio for 2020, and you have in gray the coverage ratio of last year, 2019. So what can we see here? we can see that there is quite a lot of diversity. When you look at the figures on the stage one, you see that you have quite significant differences between the banks. You have banks with a coverage ratio that is around 0.06 or 8, and then you have nearly 10 times ahead of that other banks at 0.5 something. So you see that there is quite divergence. Once again, we should pay attention to the underlying portfolio, which may explain such difference. But it's interesting to see that once again, we already identified that at the benchmark for the 13th of June 2020, we have the same kind of ratio, which is you have a ratio of 1, 10, 100. You have roughly, it's an approximation, but on stage one, you have a given coverage ratio. If you multiply it by 10 or 20, you find the stage 2 ratio, and then you have to multiply again by 10 to find the stage 3 ratio. So that explains why, even if the stage 3 in terms of gross carrying amount is much less than the stage one, hopefully, it actually drives the amount of ECL allowance because it's more than compensated by the increase of the coverage ratio. Now, if we look at the trends between 2019 and 2020, we see that it's interesting to note a significant increase on the stage one, because the average coverage ratio last year was 0.16, this year it's 0.23, which is not a big number, but it is an increase by 44%. And given the amount at stake in terms of gross carrying amount, this is quite a significant increase in terms of coverage ratio. When we look at the stage two, there is an increase as well, but it's half of the increase of the stage one, with an increase from 4.13 to versus 3.46 last year. So it moved in from 3.46 in 2019 to 4.13 in 2020. So it's an increase of roughly 20%. So it's a significant increase again, but it's half of the plus 40% we have seen on the stage one. And then you have the stage three, which actually is fairly stable. So we don't have a significant modification of the coverage ratio for stage three instruments. Now, the point, we can move to the next slide, and you will see here a representation which is a breakdown of, for amortized cost instrument, of the gross carrying amount of the assets between stages. So if we look at the graph on the left-hand side, you have in green the proportion of the amortized cost portfolio that is in stage one. You have in gray the proportion that is in stage two, and you have in, let's call it pink, the percentage that is in stage three. To see how things changed between 2019 and 2020, we decided here not to classify the banks by a geographical order, but from the bank who had the largest proportion of stage one instrument to the banks at the bottom of the slide that has the lowest proportion of stage one instruments. And then we move on the right side to the situation in 2020. And you see that if we had to reclassify in the same way the banks, it would have significantly changed. The proportion of stage one has been really modified between 2019 and 2020. And we will see that more clearly in a couple of slides later, but basically you see that there has been an increase of the proportion of stage 2 gross carrying amount and a reduction of the proportion of stage 1 gross carrying amount. If we look at the average level, you see that stage 1 was as an average level of 91% in 2019, and in 2020 it decreased to 88%. And if we look at the average weighting of the stage 3, it's actually stable. It was 2.6% of the portfolio on an average basis in 2019, and it's exactly the same number in 2020. But the situation changed from one bank to another. So on the average, stage 3 was stable, but behind this number, there is quite differences between banks. If we move to the next slide, which represent in the same way, but here we focus on not on the gross carrying amounts, but on the allocation of the ECL allowance by stages. So you have in green the ECL of stage 1 instruments, you have in gray the ECL allowance of stage 2 instruments, and then you have in pink the ECL of stage 3 instruments. And you see what I said a couple of minutes ago, that clearly the amount of ECL allowance is mainly driven by the ECL that comes from the stage 3, despite that the fact that the gross carrying amount of stage 3 is about 2%, the coverage ratio that is applied to the stage 3 instrument is so important that it in the end drives the final ECL allowance amount. If we look here at the variation, well, there we have quite diversity. It's not that easy to identify, I would say, geographical consistency. So we can just have a look at the averages. So the average weighting of stage 1 instrument was 10% in 2019. It moved to 11.6% in 2020, so a slight increase. But the average proportion of stage 3 instrument in terms of ECL allowance has experienced a significant decrease from 73% to 65%. And you can see it on the graph. You see that the gray zone have significantly increased. So it means that one can expect that the stage 3 decrease to the benefit of the stage 2 allocation. And that's something we will see clearly on the next slide. So here you have a comparison, an explanation of the variation. So on the left-hand side, we focus on the gross carrying amount by stage. And you see for each bank, what is on the left of the graph is a decrease. What is on the right on the graph is an increase. Keeping in mind that as it is a percentage, the sum of the left part of the graph equal the right part of the graph. So we see here clearly that on the negative side, we have a decrease that is mainly oriented on stage 1 instrument. And most of the increase in terms of gross carrying amount is definitely a stage 2, which is quite consistent to date. We see with the increase of the risk over the year, it seems logical that we see some stage 1 instrument moving into the stage 2. Then if we look at the right-hand side graph, you see that here we have exactly the same principle, but based on the ECL allowance by stage. So you see that the ECL amount has been decreasing on the stage 3, but with an increase mainly on the stage 2 and to a lesser extent on the stage 1. It doesn't mean that the ECL amount of stage 3 have decreased. Here what we represent is the proportion. So we have seen that the stage 3 ECL amount have been stable. But if they are stable, while the stage 1 and stage 2 ECL allowances increase, the proportion of the stage 3 decreases. So what we can say here in terms of ECL allowance globally on the portfolio on the sample of European bank is that the ECL amounts have increased. We have seen that on the first slides. But this increase has not been through an ECL increase of stage 3. It has been mainly driven by an ECL increase in stage 1 and, of course, stage 2. And that's the way things have evolved this year. Well, one point that would be interesting is to follow up on this slide and to see if the stage 2 allowance could move in the coming month, the coming years, into a stage 3 allowance. We will see that later on. Florence, we move to the next slide.
No. This slide is dealing with the data available on transfers between stages for amortized cost assets. Those transfers data are available in the reconciliation tables required by IFRS 7. And this graph is aiming to present the diversity in the scope of these reconciliation tables. 19 banks disclosed these reconciliation tables for both gross credit exposures and ECL allowances, which appears to be a good practice. The great diversity of the data scopes shown here and the lack of more granular information reduce the comparability from one bank to another. If you look at the graph, you will see that the scopes are very different. Some banks present loans, sometimes split between banks and customers. Some banks disclose only customers' loans, some others loans and debt securities, others aggregate loans and off-balance sheets, and other bank, just one in fact, aggregates loans and debt securities and central banks. Now, if we move on to post-model adjustments, we define a post-model adjustment as any adjustment made outside the IFRS 9 models. And we present here the sum of these adjustments. Among these adjustments, not all are linked to the COVID crisis, as some adjustments are recurrent ones, and they depend on the underlying models. This graphics presents the weight of the sum of those post-model adjustments in the ECL charge, so in the P&L, at year-end 2020. Now, if we look at the figures, the average weighting of post-model adjustment is 27%, which is quite a significant weight. And again, the diversity is quite wide because this weighting goes from 5% up to 95%. Now, if we try to see some trends, you can see that half of the sample is between 20 and 35%, but we don't see any geographical trends. Concerning the good practice in disclosure, we can note that 6 banks have disclosed the post-model adjustment impact in their reconciliation tables, which really is a good practice. And now we can go through the underlyings of those post-model adjustments.
Yes, 27%. That's a huge number. That means that on an average, when a bank have booked an ECL charge of 100, 27% came out from a post-model adjustment. That's really a significant number. So what were the main reasons that the bank mentioned to justify the existence of such post-model adjustment? The first one, and by far, is the offset of moratoria on governmental measure positive effect. That is to say, these measures had has an impact to, for example, having a positive impact on the cash available by the debtor. And the models reacted very positively to that. And as a consequence, the model considered that the risk was low. But the banks had to challenge that, saying, okay, but the measure are not forever. So what will occur? What is the actual risk behind that? What would be the cash position of the debtor if there were no such measure, and how would that change over time in the coming months and coming years? So that was the post-model adjustment that was the most frequently mentioned by the banks to justify these figures adjusted. The second one, mentioned by 11 banks, was on the uncertainty and uncertainty in the macroeconomic outlook, which makes sense, but we could question whether it should be tackled this way or addressed through, for example, the forward-looking information that on which Florence will come back in a couple of minutes. And then you have some, I would say, sectorial approach with just the slide before, please. Thank you. You see that 8 banks mention vulnerable sectors in the context of COVID-19 context, and then sector or subsector vulnerability by a reclassification of a full sector in stage 2 that is mentioned by 7 banks. So you have here 15 banks who said that they had a sectorial approach to justify their post-model adjustment. So now we can move to the next slide to see which are the sectors that was most often mentioned by banks. So you see you have the classification there. So you see that hotels, hospitality, catering, oil and gas, retail, distribution were mentioned by 15 banks. And then there comes commercial real estate, transportation, leisure entertainment, aviation and travel. So quite surprisingly, tourism is only mentioned by 7 banks. I personally thought that it was that it would have been higher in the ranking, as well as aviation and air travel, which could be higher. But it's important to keep in mind here that each bank mentions sectors that are at risk based probably on their portfolio. That is to say, some banks may consider the tourism sector as something under watch list, I would say, but if they don't have significant exposure in this sector, they won't mention it. So it has to be taken into account that banks are considering the sector on which they are exposed, and that may explain why some specific sectors are not that often mentioned by the banks. We can move to the next slide.
And we will move on to forward-looking information, which is present here with the first slide. We notice quite an improvement in the information disclosed. As you will see here, 18 banks disclose quantitative data at year-end 2020 and year-end 2019. We analyzed the forward-looking information with 3 topics: the weightings of each type of scenarios and the underlying parameters in order to go into the scenarios, and the sensitivity analysis. So if we look now on the weightings of macroeconomic scenarios, First, we have classified the scenarios in three main types: the optimistics or upside ones, which are represented with the green blocks, and the neutral or baseline scenarios, which are represented with the gray blocks, and finally the downside or pessimistic scenarios, which are represented with the purple blocks. The first graph on the top of the slide shows the weightings of these three types of scenarios, and the bank have been classified according to the decreasing weighting of their optimistic scenarios. The second graphic presents the change in the weighting of each type of scenarios between year-end 2019 and year-end 2020. Now, if we look at the figures, these two graphs are an illustration of the diversity of the approaches applied by the banks. If you look at the weightings of the optimistic and pessimistic scenario, you will see that the weighting of the optimistic scenario ranges from 44% on the left of the graph to 0% on the right of the graph. And this diversity is illustrated too with the change of those weightings between 2019 and 2020. As you will see, some increase the weighting of their optimistic scenario, other of the baseline scenario, and other of the pessimistic scenario. So it was quite very diverse approaches. Now, if we can add one point, because we made the analysis, and a high weight of the optimistic scenario doesn't lead to a low coverage ratios, which is quite an important information to have in mind. Now, if we try to understand more in depth the composition of each scenario, we analyzed the underlying parameters and their projected levels. This is presented in this slide. 22 banks have published quantitative information dealing with their parameters, sometimes very detailed information. And among these parameters, the most quoted are the gross domestic product and the employment rate, which is not quite a surprise. We have succeeded to compare the quantitative information dealing with these parameters with the ECB scenarios only for the Spanish and Irish banks. And we can see that there is no very clear geographical trend. If we look now at the sensitivity analysis, which is our third and least topic about forward-looking information, we define the sensitivity analysis as any change of the ECL charge or the ECL allowance due to a modification of a calculation parameter. For instance, the weight of the scenario, of one scenario, the level of the GDP choose, and the recovery date of the economy. The data present here are at year-end 2020. And please note that the total of the graph is above 26 banks, which is the number of our samples, because several banks gave several sensitivity analysis. Now, if you look at the different methodology that the banks have applied, you will see that these methodology are very diverse. In fact, some banks took the staging migration and see how much the ECL allowance or ECL charge have changed if more of their portfolio have migrated to the stage 2. Some show one or several parameters. Some change the weighting of the downside scenario, and some change the weighting of the scenario, the pessimistic scenario, and take into account the migration in the portfolio to the stage 2. We note quite an improvement because all the sample gave this sensitivity analysis, but as you see, with a very wide methodology.
Well, that's the end of the analysis of the ECL topic, which was our main focus. We have to go through two remaining topics, which may not be that recurring, but that was topics of the year for 2020. The first one is the TLTRO3. We ranked here the banks depending on the amount drawn at the end of the year 2020. And you see that the use of this financing mechanism has been very diversely used by banks with quite a wide range in the amount that has been drawn, moving from 133 billion euro, and you have some banks around the 27, 28. You have the UK banks, which are even lower, but it may be a specific situation. So 18 banks have disclosed information about the TLTRO3, but one of the questions we had accounting-wise was how did the bank decide to account for the 50 BP bonification? 11 banks mentioned this, and 9 out of the 11 explained that they have recognized this bonification over 1 year, from June 2020 to June 2021, and 2 banks spread the effect of this 50 BP bonification over a period to the maturity of the TLTRO3. Then the second question, and it was one of the recommendations of ISMA, was to say whether you consider this bonification as something that is within the scope of IS 20, qualified as a government grant, or whether it is within the scope of IFRS 9 as a financial instrument with a TLTRO3 interest rate, which is defined as being by nature a market interest rate. And then the ISMA asked to the bank to explain what was the choice or their interpretation. And you see that the outcome is quite mixed, with 4 banks going for IFRS 9, 3 banks for IS 20, and 4 banks that decided not to provide any details in this regard. That was for TLTRO3, and moving to the last topic of this presentation on the IBOR reform. I think that at the beginning of 2020, everybody was considering this as being one of the major topics for the year, and in the end, it was really well behind the COVID-19 effects. Accounting-wise, what we can say is that half of the sample, a little bit more, decided to apply only the phase 1 of the amendment provided by the ASB to manage the IBOR transition. So, but 12 banks out of the 26 decided to early adopt the phase 2 in order to either because they needed it for addressing the change in their contractual feature in order to move from the old interest rate benchmark to the new one, or I would say by security, or as a case may be, as it offers quite a lot of flexibility. So a very little majority in favor of not applying the phase 2 not early apply the phase 2 in 2020, but all the banks will have to apply it in 2021. What we can note here is that for the bank who only apply the phase 1, most of them made an effort providing disclosures that were required only by the phase 2, but they've nevertheless decided to publish it even if they are only under a phase 1 approach. Well, that's the end of our presentation. Thanks a lot for your attention. We will now have a look at the question you sent us. There is quite a few of them. We will try to answer 2 of them in the 5 minutes that remain. Sorry for the one we did not take, but you don't hesitate to share it with us, and we will try to answer later on. One of the question is, how do you see the comparability looking forward? It's true that when we prepared this benchmark, we had quite difficulty to compare the banks among them, because as we have seen in the slides, they rarely use the same items in terms of providing information. They provide coverage ratio, but not on the same scope. They provide information by stage, but some do that from amortized cost instrument, the other do that for debt instrument, other put their off-balance sheet item as well in there. So we will probably have more granularity in the future, but the question is whether this granularity will be consistent enough among banks to really perform more detailed analysis, and that will be an open question. So we clearly explain more detail in the future, and maybe with the exercise led by EBA would to a certain extent influence the level of detail that could be disclosed. But the question is whether it will be sufficiently standardized to improve the comparability. So benchmarking is always a difficult exercise, because to be really relevant, it would be better to do it business by business, and probably for each geographic area. And at this stage, based on audited information that is available in the annual report, we don't have that kind of granularity to perform such analysis. And the second question we have is, what could be the key topic of 2021? I think that, well, I would say the first one could be the end of the transition measure provided by the government, and the end of the moratoria, the end of the state guarantee mechanism, how the debtor will get out of that, and what could be the impact of the end of this support measure on the staging of the instrument. We have seen that we have quite a few that move from stage 1 to stage 2. The key question is whether they will move to stage 3 or stay in stage 2, maybe go back to stage 1. That's because some of these measures are hiding the actual situation on the cash position, for example. So probably over 2021, we will have more information on what is the actual situation. That could be probably the one of a significant point, and the other significant point is how fast will the European economy recover from the COVID-19. We have seen that there was some diversity in the bank's position there. It will clearly impact the forward-looking information, and we have seen that maybe post-model adjustment may be reflect such diversity. That I think would be the main area of focus. Maybe one more question. No, I don't get it. So I will close this presentation here. Thank you very much, Florence. Thank you very much to all the attendees for your attention. You have already received an email with a link to download the presentation. You can find it in any case on our website at mazars.com. Thanks a lot for your attention and have a good rest of the day. Goodbye.
Goodbye.